A few days ago, we looked at strip mining of countries like United Kingdom, France, and Germany, and the kind of impact they are having on the pension funds and the banks there. Today, we are going to look at the big enchilada, the United States of America. Has strip mining also weakened the institutions here? What are the exposures? What exactly is strip mining when it comes to United States? What is the role of private equity in all these things and more? This is important because this will tell you, for example, if you happen to be, in the CalPERS system, which is like the Teachers Pension Association of California, one of the biggest pension funds, and if these people have been tempted to put money into private equity, what kind of consequences happen? That's what I'm going to talk about, what kind of risks they are taking, and if this thing collapses like a pack of cards, who will foot the bill? What happens to all your annuities? You're getting a fat check every month. What happens to that? And all that and more in this. Please like this video. I'm just mentioning CalPERS as an example. It's one of the bigger ones that I know of. They've made a lot of good investments, but these days there are lots of murmurs going around that many pension funds have been aggressively investing in PEs, and PEs have a very bad dark reputation that precedes them. And I'm just going to help you understand what is going on, because when this surprise happens, I'm not saying if, when this surprise happens, you don't feel that surprise. Okay, so finally this domino has fallen. We need to do some corrective actions for ourselves also. Everything is frothing up is my contention. I could be horribly wrong, of course, but I believe that things are frothing up and very soon this bubble is going to burst. People say 2026, some people say no, it will take a little bit longer, but be that as it may, either way, we need to understand the underlying dangers that face the American banks as well as the pension funds. So a small infographic that helps you understand the role of PEs in these things, pension funds, and also what is the role. Why am I questioning what the PEs are doing? That is the important thing. You'll understand that when you look at the slide deck. Here we go. Strip mining of United States financial institutions, an analysis of private equities, impact on pension funds, banks, and systemic stability. See, what happens is private equity firms have a certain set agenda. What they do is they acquire companies or banks using significant debt. And then what happens is they extract a maximum short-term value by loading the company with more debt and then paying large dividends to themselves and then moving about aggressively cutting costs. In other words, a good company with good cash flow, when it falls into the hands of PE, they strip the whole thing, they load it up with more debt, and in order to service the debt, they need to have cash quickly. So what they do is, first of all, they'll aggressively cut payroll, then they also start dumping assets, something that I explained to you in the other strip mining series episode on UK and France and Germany. So you get the idea. Same thing happens. Maybe it started in US first and then it has found its way across the pond. I don't know, but the PE stuff is what really is queering the pitch. And I'm going to go into a little bit more details as to why pension funds seek PE, private equity, seek to invest in that, because it is high risk, high reward. But remember, viewers, the PE companies will extract their fees whether they make money for you or not. This is where the problem I have with it. Instead, if these people had invested in slightly less risk but less also yield companies, maybe the American companies would still be standing. A lot of the companies have fallen by the wayside. I don't know if many of you have watched this series called Suits, very clever series, 4 or 5 seasons if I remember correctly, and every episode talks about something like this. So do go back and watch it if you have not already watched it. It's a very interesting study on what happens, what is the play in the back, how situations are created that make healthy companies to start hemorrhaging money. So where is the capital source for the private equity companies? It is the pension funds. And why do pension funds give their money to private equity? Because they have massive long-term unfunded liabilities. So this means that they are falling behind the 8 ball in terms of paying out to their pensioners wherever the money they have collected. they would have said, okay, we are going to give you so much money, and then they would also have indexed it with inflation to cover for the inflation. And guess what? The money that they owe to their customers is becoming harder and harder to make, so they need to go and figure out a way to get huge returns on their investment, which is why they start investing in private equity firms. So what is the process flow here? Let me just first tell you the amount of exposure. The total US retirement asset, meaning companies that have invested in pension funds and other things, is 33 plus trillion dollars, and public pension unfunded liabilities is about 1.5 trillion plus trillion. So we are talking numbers in trillions. So what happens when strip mining takes place? First thing what they do is the PE firm, private equity firm, will raise billions from the investors led by pension funds. So that's where the money comes from. Then what they do is they do what is called as a leveraged buyout. They acquire a target company or bank using mostly debt placed on the target's book. So basically they load up the bank or the entity with more debt. Then what happens is they extract value out of it by first paying large dividends to PE owners, second, load the company with more debt, and then third, cut costs, R&D and staffing. Essentially, it's like sucking out the entire pulp from a mango and leaving just the seed. I know I make this example once in a while. It's just that it makes the most sense when you try to understand healthy companies, healthy banks fall prey to this method. And then finally, they exit, sell the often weakened company, either using an IPO or another buyer for a profit. So essentially, in every step of the way, the PEs make money for themselves and perhaps a little bit money for the pension funds who are funding them. What is the need for pension funds to fund PEs, private equity firms? Well, what it is that the pension funds need to meet ambitious targets of over 6.5%. And what has happened is, in order to make that thing consistently, quarter after quarter, it has forced the pension funds to shift from safer assets to, like for example, bonds, to riskier, illiquid alternatives. This chart shows the typical shift, showing a significant allocation for assets whose high fees and risks are often opaque and directly expose retirees' futures to market downturn. So this is a portfolio of a typical pension fund. What are the things they do? In public equities, they put about 40%. In fixed income, that is bonds, they put about 30%. Then in real estate, they put about 10%. And then look at this big one, alternative assets, private equity / credit, they put 20%. In other words, out of $5, $1 of pension funds is going into private equity because they feel that's the only way they can exceed or reach the 6.5% return target, which is what they feel they need to have in order to service all the payments that they need to make for all their investors. That is the retired pensioners, teachers, and so on. Now let's take a look at the rise of shadow banking. What exactly is shadow banking? Do you know the size of shadow banking? $200 trillion. Yeah, you heard it right. T as in Tom. $200 trillion. And this has made the traditional banks very cautious. Now, the private credit funds, part of the shadow banking and also perhaps run by the PE, they search to fill the gap because the banks are not willing to lend money, and this has eroded the bank's core lending market. The banks were tightened because of the squeeze and the TARP funding, all the stuff that happened in the great financial crisis, and therefore the banks were not lending, so the shadow banking stepped in. This trend has created a systemic risk as the regulated banking system is highly interconnected with this less transparent shadow sector. For example, if you take a look at this graph here, the relative market size indexed is, if you think of traditional banking as being at 100 in 2015, it has barely risen from there to 125 in 2025. That is an estimated. But if you look at shadow banking, It came out of nowhere. Private credit, NBFIs, non-banking financial institutions, it was at 30 in 2015, and look where it has gone now. It has gone to 180. Soon it will be almost 50% more than that of the traditional bank lending. So what happens? Will this lead to US financial institutions to fail? Well, the consensus is no. They are not on the immediate verge of a 2008 style collapse. However, this stability is deceptive, masking significant underlying fragility and interconnected risks. So let's take a look at the banking system. How stable is the United States banking system? It is resilient, but it is vulnerable. Why? The core US banking system is better capitalized than in 2008, cash reserve ratio. The key vulnerability is not its own assets, but its deep, opaque exposure to the shadow banking sector. A crisis in private credit could easily trigger significant unexpected losses in the regulated banking system also. So this is as far as the banks are concerned. What about the pension funds? The crisis here is one of long-term solvency, not immediate failure. That means, like I said, what happens if the pension funds are not able to make 6.5% yield? Then will they go back to their investors and say, sorry, this year the dividend is going to be less because we only averaged 5.5? How will the investors take it? Many of them, this is their bread and butter. This is their pension. So what are they going to do? So these kinds of problems will start happening, and sometimes they are locked into these funds. They may not be able to take the money out, or if they do take the money out, that could make a run on the pension funds. So that's also another problem. The key problem here is the funds are highly dependent on achieving ambitious, often unrealistic investment returns to close their multi-trillion dollar funding gap. They are surviving on market rebounds, not resilient by design. So here is the actual numbers, okay? Assumed average return is about 6.5%, but estimated return needed for solvency, meaning over a long period of time, how much do they need, is actually 2.5 percentage points more, close to 9%. So the return on their investments that is needed to be solvent is, like for example, 9% now. This could be becoming more with time. So this gap between 6.5 and 9, 2.5%, is driving them towards risky private markets, creating a fragile loop. Pensions fund the shadow banks, which in turn are deeply entangled with the traditional banks. The greatest system is not a single failure, but a cascading one through this entire opaque system. And that's exactly what happened when you got the 2008 crisis. So crisis in another name could happen as early as next year, or it could take a few more years to take place. Right now, the strip mining hasn't done much of a dent or it's not done enough of a dent to damage the whole thing, but it is getting there. Is the Trump administration going to come up with some rules that will kind of limit the exposure of pension funds onto these PEs? But then where will they get the money that they need to have the payouts? What happens there? Are they going to try and is the Trump administration going to try and weaken the dollar so that the inflation will basically help them with the percentage to tide over? That's something that has to be thought of. I'll be coming back to this. We'll be talking with the other experts, banking experts, on what is going on, and we'll give you more light on this. I hope you understand when somebody says strip mining XYZ, what that means. Thanks for watching. Please like, share, and subscribe to our channel. Don't forget to click on the bell button for notifications. Namaskar.